There's a rule sitting inside your retirement account that many retirees don't fully understand. And depending on your circumstances, it can lead to unnecessary taxes over time. It's called the Required Minimum Distribution, or RMD. And if you spent your career contributing to a retirement account, this one applies to you. Here's the number that surprised me when I first saw it. A study from JP Morgan Asset Management tracked 31,000 retirement plan participants over several years and found that 84% of retirees who had already reached RMD age were taking out only the bare minimum the IRS required. Not what they needed, not what they planned for, just the minimum. And 80% of people who hadn't yet reached RMD age hadn't touched their accounts at all. On paper, that sounds cautious and safe. In real life, it can mean higher taxes later, bigger forced withdrawals in your 80s and 90s, and missing out on some of the best, most active years of your retirement. So today, let's walk through this slowly, the way I'd explain it sitting across the table from you. By the end, you'll know exactly what an RMD is, some of the details that even careful people often overlook, and some of the tools that may help you plan around this rule. Let's start simple. When you put money into a pre-tax retirement account, you get a tax break going in. That money grows without being taxed. But the deal with the government is you can't leave it in there forever. At a certain age, you're required to start taking a minimum amount out every year. That's your RMD. RMD rules apply to any pre-tax retirement account. For many people, that includes traditional IRAs, 401ks, 403bs, and 457 plans. It also applied to the inherited versions of these accounts, which follow their own separate rules. RMD rules do not apply to your own Roth IRA. And as of 2024, they generally no longer apply to Roth 403b or Roth 401k accounts for the original owner either. Inherited Roth accounts are a different story. I'll touch on that in a moment. Under the Secure 2.0 Act, your RMDs generally start the year you turn 73. If you were born in 1960 or later, that age moves to 75. Here's a detail many retirees don't realize. In your very first RMD year, you get a choice. Take that first RMD by December 31st, or delay it until April 1st of the following year. If you delay it, the IRS still expects your second RMD by December 31st of that same year. That means 2 RMDs land in one calendar year. For people who also have a pension, that double income year can push you into a higher tax bracket, make more of your Social Security taxable, and trigger higher Medicare Part B and Part D premiums, what's called an IRMAA surcharge. Many people only find this out after they've already made the choice. That's exactly why we're talking about it now. Here's how RMDs are calculated. Each year, your custodian takes your December 31st balance from the prior year and divides it by a number from an IRS life expectancy table based on your age. That gives you the minimum. That percentage starts around 4% in your early 70s and climbs to 5%, 6%, and higher as you move into your 80s and 90s. If you don't take enough, the penalty was previously 50% of the shortfall. Under current rules, it's generally 25%. And if the shortfall is corrected within the IRS's correction window, that penalty may be reduced to 10% by filing Form 5329, and in some cases waived, depending on the circumstances. So missing an RMD is serious, but it's fixable if you act on it. Next is an area where even careful, detail-oriented people can get confused. And it's especially relevant if you've moved between various employers throughout your career. With IRAs, you calculate the RMD for each one separately, but you can add them together and withdraw the total from just one IRA, or any mix of them. 401k and 403b plans generally don't work that way. If you have 2 old 403b accounts from 2 different employers, you typically must calculate and take a separate RMD from each plan. You can't cover one with the other. Some 403b plans do allow aggregation similar to IRAs, but that depends entirely on the plan's specific rules, so it's worth asking your provider directly. Another important note is that if you're married, each spouse has their own RMD based on their own age and their own balances. One spouse's withdrawal never covers the others, even from a joint perspective on finances. A question that comes up from time to time is, what happens to RMDs if I'm still working? If you're still working at RMD age, you may be able to delay RMDs from your current employer's plan. If the plan allows it and you own less than 5% of the organization, please note this does not apply to traditional IRAs. And it doesn't automatically apply to old 403b or 401k accounts from previous employers. If someone's goal is to continue delaying their RMD while working, and they have retirement accounts from previous employers, they may be able to roll them into their current plan if their plan allows it. A lot of people think still working means no RMDs and assume it covers everything. It doesn't. Every RMD is taxable income, unless you use certain charitable strategies we'll cover in a moment. Here's the part that surprises people. Even if your RMD fits neatly under your standard deduction, the IRS still counts it towards something called provisional income. Your RMD plus other income plus half your Social Security benefit. If this total crosses certain thresholds, up to 85% of your Social Security becomes taxable. Let's also factor Medicare into the mix and how income levels affect your Medicare costs. Medicare looks back 2 years to decide if you owe IRMAA surcharges on Part B and Part D. This is important because a high RMD year or a year with 2 RMDs can push you into those extra charges without you realizing it until the letter arrives. That's why some retirees spread RMDs out monthly or quarterly instead of taking one lump sum in December. A few strategies worth knowing about. Qualified charitable distributions. If you're 70 and a half or older and charitably inclined, you can send money directly from an IRA to a qualified charity. It counts towards your RMD without counting as taxable income on your return. It must come from an IRA, not directly from a 403B or 401k. Roth conversions. Moving money from a traditional account to a Roth means paying tax now, so it can grow tax-free later with no RMDs attached. The window right after you stop full-time work, before RMDs and full Social Security begin, is often when income is lowest, which can make conversions more efficient. Delaying Social Security. Some retirees delay benefits to age 70 and use that lower income window to do modest, deliberate Roth conversions. Spending from different buckets on purpose. Taxable accounts first, modest conversions along the way, letting Roth assets grow as a longer-term resource. Most importantly, none of these solutions are one-size-fits-all, and it's always recommended to consider your full financial picture before making any decisions. Today we covered what an RMD is, which of your accounts it applies to, the age rules under Secure 2.0, how the calculation works, the still working exception, and how RMDs can affect your taxes, Social Security, and Medicare. If some of this still feels like a lot, that's completely normal. This isn't common sense. It's a complicated set of rules most of us were never taught. What matters isn't memorizing every detail today. It's remembering that you don't have to be afraid of this, and you don't have to figure it out alone. So, how can this actually be a benefit to you? Sometime this week, write down every retirement account you have. Old 403B plans, 457 accounts, rollover, IRAs, anything from a previous employer. Then bring that list to a conversation with your financial planning team. That's exactly the kind of review we do at Stonebridge for people who've spent their careers working hard and now want their financial plan to work for them. Take your time to review this and know that you don't have to navigate it alone. Thank you for watching, and I'll see you in the next one.